Gold's multi-year rally still has legs, driven by structural inflation risks and the likelihood of renewed monetary expansion as governments lean on fiscal stimulus.
Welcome to the Morning Markets and Metals with Vince Lancy, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. I'm Vince Lancy, and this is the Market Rundown. We're going to talk about gold's 2025 outlook, secular strength, and potential choppiness, inspired by something I read on Bloomberg as translated by Zero Hedge. Okay, we're also going to do a little CPI prep. Starting with the markets, 10-year yields are unchanged offered. The dollar is 109.63, up 13. The S&P 500 is 58.45, up 3, almost 4. The VIX is 19 and change, unchanged. Gold is 26.69, bouncing 6 and change. Silver is 29.73, up 13, almost 14 cents. Copper is 4.30, strong again, up a penny. WTI 78.40, down 46. It was up about 70 cents about 2 hours ago. Natural gas is 381, down almost 15. Bitcoin is 95,900, up 1,500. Palladium 947, up almost 5. Platinum 953, down 2. Gold, silver, again, right below 90, teasing 90. Soy, corn, wheat 1048, 466, 553. Unchanged bid. All right. Front page. There are the three, I'd say, the most popular stories, or most current stories anyway. HeartNet 33.33, gold. Weekly, the big silver stock out of 2025. And we just sent out, we had a conversation with Bob Coleman of Profits Plus ID, and we just sent that recording out to premium subscribers regarding the EFP and the mechanics thereof, and how that could create the potential for the stock out described in the weekly report on the top left quadrant of your screen. Okay, today, discussion, normalizing higher inflation. That's just my comment. Goldman Sachs CPI review. CPI is tomorrow. I'm going to quote them, we expect a 25 basis point increase in December CPI, corresponding to a year-over-year rate of 3.27%. There are three key component level trends we expect to see in this month's report. First, we expect used car prices to increase 1%, reflecting an increase in auction prices. Second, we expect another increase in airfares. That's seasonality. Third, we expect a slight acceleration in the car insurance. I like the terminology, slight acceleration, meaning it's going to get even faster. Your car just went from 210 miles an hour to 215 miles an hour. So when you see slight acceleration, that's after a large, general, broad acceleration. You're already speeding into a wall. Anyway, cynicism aside, gold's outlook, secular strength, and potential corrections. Now, yesterday I read a piece by Bloomberg's Simon White, as translated by Zero Hedge. One of the terminal pieces that they cover. And I took some of his charts and wrote some comments related to what he was talking about with those charts in mind, and added a chart or two of my own. And because it actually gives a good description of 2025, right? It's, look, the market's not going anywhere right now. So now's the time to do it. All right. So gold's outlook. Gold's multi-year rally still has legs, driven by structural inflation risks and the likelihood of renewed monetary expansion as governments lean on fiscal stimulus. Central banks, the cornerstone of gold's recent rise, have increased their holdings amid persistent inflation, a byproduct of fiscal profligacy, and the dollar's weaponization against geopolitical adversaries. All right, so here's some thoughts on key drivers of gold's behavior, and a way to put this in context, hopefully giving us some patience as we go forward. We've been a little spoiled this past year. All right, let's see. There we go. First picture. Can I make it bigger? Yes, I can. I have a lot more written at the bottom, but I'll just give you a quick comment. Emerging markets like China and Russia seek to reduce reliance on the dollar, hence de-dollarization. Uh, the dollar is increasingly used as a tool of economic coercion. Or put it this way, we've all begun to realize that. Developed economies are following suit, hedging, according to Bloomberg, against fiscal risks tied to growing deficits. Yes, but when you put those two statements together, they're also hedging against fiscal risks from the BRICS because you have to interface with them economically. All right. Next, the Neo-Keynesian trap, my terminology, not Bloomberg's. Uh, Deficits have grown even as unemployment remains low, signaling a new norm. Governments as first responders in economic management. This, quote, fiscal put replaces the traditional Fed put, raising concerns about who, if anyone, has access to a brake pedal on this accelerating financial sloppiness. To zoom out a little bit, tie a couple generations here together. Before the Fed was the rock star that managed the economy's problems, things were done fiscally. The Fed became the rock star to help uh, uh, steer long term policy through short term mechanisms. Now you have a situation where the Fed put is no longer effective, or it is effective in Powell's case, and the Fed Powell is no longer happy with, I'm defending Powell here for a second, no longer happy with the fiscal situation. And so the fiscal situation says, think of Yellen, says, you're not going to ease, then we're going to print for you. And that's where we are now. The global fiscal put is where the government spends money at the fiscal level in order to keep the economy going. Whereas it used to be the government was supposed to spend this money to get the economy going. Keynesian economics says, hey, deficit spending is okay if you need it. And Neo-Keynesian economics says, we always need it. Okay, so that's my take on that chart there. Potential near-term correction. Now, this is the expectations management portion of the show. Factors such as weakening Asian demand, potentially, particularly if China's recovery falters, or a less dovish Federal Reserve, which we're realizing now, will apply downward pressure. Now, that's not in the absence of upward pressure. The point is the market doesn't necessarily have to rally right now. Rising global yields, historically a headwind for gold, also loom as a potential risk. Although why those yields are rising makes all the difference. If they are discounting higher inflation, then gold drops. But if they are combined with weaker currencies, as is the case in the UK right now, then that's a broader fear of default risk morphing into debasement. If the world were not in an anti-Goldilocks situation, then these correlations, dollar, gold bonds, then these correlations or mechanisms for transmitting risk mitigation would be operating smoothly, but they are not. Correlations have broken down. And as a result, higher bond yields beget higher gold. And that will continue to happen to varying degrees until spending is reined in or productivity is increased beyond the norm. Meanwhile, those in charge feel, that's the fiscal side, feel the best way to handle all spending issues is to spend more and hope some invisible hand fixes things down the road. Now, why this chart? There's a big zoom out here, all right? The last three times gold on a monthly chart got way overbought. Okay, that's RSI at the bottom, represented by the green rectangles. It took the red rectangle time frame for a new high to be made. So the first one I don't have the dates showing on here, but the first one starts in around 2006. We make a high, the market gets overbought, the market travels sideways for almost 2 years. And then in 2008, halfway into 2008, it happens again, and the market travels sideways lower, kind of a bull flag, for about a year. The next time it happens, believe it or not, it does not get that overbought in 2011. The next time it happens is 2020. In 2020, the market gets way overbought, coinciding with a new high, and it takes 2 years, probably February of 2022, for that to be broken. So the market side watch sideways, lower, bowl shaped, kind of like sideways, and then higher. Now here we are in 2025, having made a new all-time high in 2024 with an RSI that comes in where that green rectangle is. So the question now is, what will happen and how long will it take to happen before we go up? If you're a holder of gold and you understand risk and you don't do things just because people tell you to do them, because I'm not telling you to do it, you should consider, that's what the word means, consider if you're long gold and you don't want to sell it, if you're long gold and you have no need to sell it, and you have the margin capacity, covered call writing might not be a bad idea now. I happen to think it's a bad idea for speculation. I'd be a buyer of calls speculating, but I'd be a seller of calls if I wanted to create some income. And I thought that this chart had some merit. The thing about this is these are monthly bars. So day to day, it could freak you out. Month to month, it seems okay. So are we going to go sideways for months? Look, technicians can see what they want to see in any chart. So I'm going to show you the bull scenario. The last time we had this, the market kind of rounded bottom and went up. Now, this time frame in here, this is after 2022. See, this is when the war started. All this is under a global economy. All of this is a deglobalizing economy. So I don't know that this regime is going to replicate that regime at all. So, for example, we may get something more like this, where in 2023, in December, the market peaked, RSI didn't peak, then the market chopped around sideways for a couple months and then just took off to the races, and we broke out of that. We finally broke out of the bull flag accompanying the rounding bottom, the cup and handle. So I don't know, right? You have to not know, but you have to be prepared for months of bullshit, right? Remember, we had it easy for a while there. Again, the correction is about bonds. Everyone's going to tell you bond yields, bond yields, bond yields. Well, what if bond yields don't matter to gold anymore? What if they matter to stocks? And we could be at the beginning of seeing that now. All right. Crypto and competition. Much has been made of this, so I want to just make a comment. Donald Trump's pivot towards cryptocurrencies could spur broader interest in digital assets. Could, that's Bloomberg's word, I'm going to say has, in digital assets as alternatives to gold. The risk is largely dependent on Trump and the broad stock market. This is me talking, meaning even though you can make the case that Bitcoin is not tied to tech, I would make the case that you're insane to make that case if you don't think that American investors are just people going, oh, number go up, let me buy it. They're not looking at it like it's gold. They're rationalizing it like it's gold. They're trading it like it's tech. And because of Trump's raising awareness of a boomer generation, of an older generation, Gen X like myself and older, to say, oh, look at this. Yeah, it's kind of like gold. And it also goes up. Oh, shit, I'll just buy some. Well, you're going to see, I think, the beta of Bitcoin actually increase to tech over the days and weeks. Over the months and years, I think it's going to decrease. If you think, I believe that Bitcoin is not going anywhere, but I do believe that it's going to be traded like a tech stock during Trump's term because he's raising awareness and attention to that. All right, Long-term outlook, nothing fancy here. Just a chart from Bloomberg. Structural drivers, the anti-Goldilocks era that we are in now, governments like government spending, fiat currency debasement, and geopolitical uncertainty will continue to support gold's role as a safe haven asset. And that's it. That's all she wrote. Actually, that's not all she wrote. There's a lot more at the bottom. I'm just giving you the summary of the summary. All right. News and analysis, Monday p.m. That's the post that we put out yesterday all in one place. Rabo, Jobs, Oil, and Elon's X as news source. A little bit of a recap of last week. Founders AM de-dollarization continues, but a little slower. Something I noticed in a report and sent to those guys. Zero hedge. This is the morning discussion yesterday. Biden's oil sanctions screw up. I firmly believe that. It's pathetic. Anyway, moving on from there. Today's PPI, it'll probably be out by the time you see this, 8:30 a.m. Producer Price Index. CPI's tomorrow. We gave you a hint on that final market check. Look, I'm long silver and short gold, right? And yesterday was a very bad day for me. And I'm thinking that maybe I'm wrong in general. So I'm either going to add to this, or I'm going to, you're going to laugh, or I'm going to sell copper. This is something I used to do years ago. I used to trade the three metals against each other. The economic, I used to trade silver as when it was acting too economic. I would buy it and sell gold. And when silver was acting too precious, I would sell it and buy copper. And buy gold. And then copper would be my mediator. Anyway, not something that's easy to do if you value your brain power. All right, I'm Vince. This all continues at the bottom in premium. Have a great day.
Well, thanks for watching this morning's Markets and Metals with Vince Lanci. I sure hope you enjoyed the show and that it was a great start to your day. So thanks for being here. And before we wrap up, would also like to thank Fortuna Mining, who kindly brought us today's show. And 2024, really a great year for Fortuna because they had a lot of progress now that their mine at Seguela has been fully online. In the fourth quarter, they announced that their share repurchase program had repurchased 6.4 million shares. They also had drill results where they extended the mineralization at their Kingfisher deposit at that Seguela mine. They also had a mineral reserve and resource update that they put out on December 10th. And of course, this was following record attributable earnings of $50.5 million in the third quarter, which leaves them as a company that has new mines coming online and an active exploration budget, as well as the elevated gold price, still well over $2,600. So a great 2024 for Fortuna and a lot to look forward to in 2025, especially as they have costs coming down as their leach pad expansion program at their Lindero mine is now nearing completion. So definitely a company that you will want to be aware of this year. And congratulations to Fortuna on their success. And thank you for watching, and we will see you again tomorrow. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.